So in this session, we're going to discuss a couple different advanced setups that we use. Now, one note I have to make right up front is that if you're not yet a consistently profitable trader, you shouldn't even be looking at this section right now because everything you've learned up till now is more than enough to make a great trading career, right? And you should only look to start expanding your repertoire and your tools once you're already profitable, you're already making consistent money, even if that's on small size, and then you want to expand your skill sets and find more opportunity, then you can venture into doing some more advanced setups. But before you're consistently profitable, just focus on everything you've learned so far. Make sure you have that down and make sure you're using it to trade consistently well, and then you can get into some other stuff. Now, there's many ways you can trade once you become a profitable trader, and there's many advanced setups you could take. We're going to highlight three of the ones that we find quite useful. The first one is not so much difficult on its own. It's just the fact that to use it, you'll need certain charting capabilities. They'll be decently costly per month. It costs you $150 or more a month. So if you're not profitable, there's no reason to be spending that kind of money on charting that you don't need yet. And then the next two take a bit more finesse, more experience to actually be able to trade them well. So let's check them out. The first setup is what we call demand supply walls. And to understand this setup, you really have to understand how actual order flow and how the markets really work. But it's not complex. It's the fact that when you're looking at an order book, you obviously see that there's lots of sellers in the market and there's lots of buyers in the market. Well, oftentimes what will happen is we'll hit certain areas where, let's say, we're buying and all the buying is getting absorbed by sellers sitting in the book. It's almost like a hidden wall of supply where they're not rejecting the price outright. It looks bullish, the buyers are still buying, but they're not being able to make much headway up because of all the sellers sitting in the book absorbing that buying. And then when the buying is finally absorbed, then we see a liquidation where the buyers can't push it any higher. Now the sellers become more aggressive, and then those buyers then end up liquidating and we go down. Same way on the other side, we have demand wall where the sellers are selling into it, it's absorbing all that selling, and then it goes up. So there's a certain charting platform called Market Delta, if you haven't heard of it, that has something called the footprint, and this shows you the actual order flow within the market. They basically say it's like looking inside the chart. So it's not just the typical candle, it shows you inside of it the accumulation of the buy and sell orders, and there's one way of looking at that chart to give you good setups, and we'll check that out. Setup number two is news non-reactions. We had mentioned something about this when we were talking about news before, but sometimes these can give us great trades. And the basic theory behind this is that if the market's really strong internally and you get bad news, often what will happen is the market will just shrug it off. And the fact that it just shrugs it off without really going down, initially there might be a jerk downwards, but then it quickly shrugs it off and regains it back up. And the news might have been a surprise news down, right? Like the expectations were for a certain number and it came even worse than expectations, and yet the market can't really break down. That's a lot of times great tell that we're going to go higher. Same for the other side. If the news came out great, but we can't seem to go higher, that's a usual tell that we're temporarily exhausted and the market's weaker than it actually looks and we go down. Now, unfortunately, I'm not going to be able to show you a specific example of this because I don't track this type of thing when trading. It's almost like when you're trading, you have the news and then you just integrate it with the rest of your contextual analysis. But the one thing I'll say about it now, because we won't be able to get into it on the chart, is that it's best to trade it in combination with something else. For instance, if you get bad news, something worse than expectations or even much worse, and the market initially jerks down a bit but then reacts back up, if you try to just buy right there, that could be buying in the middle of nowhere without good trade location. And because the news will likely have elevated volatility, it's probably not very advisable to do that. However, if the market reacts down a bit, kind of just stalls there and is not really showing the down move that it should on that news, but that is a good support zone and you see it holding and it's not really breaking down a lot, maybe that's a good point to buy, right? At the support zone, now you're not in the middle of nowhere. It's decent, good trade location. Often this kind of thing will be a good tell for a potential trend day. If we have all the conditions for trend and we open up and we take off in the morning on a gap, let's say up, and it's looking like a trend, but then there's some type of news at 10 a.m. Eastern, which often there is, and the market jerks down, shows a tick extreme, but it's not really breaking down, it's kind of holding. And you know that there was a potential for an uptrend day, and now all this bad news, and we were only able to go down 3 points or something, and we hit the tick extreme, but we're holding. That can often be a great long right there. So these type of things are like in combination, it becomes almost a confluence with the other things that are already showing in the market, and then you get this added to it, and there's a potential zone or some kind of extreme. These can end up being great, and you can just pile on because the reaction the other way is going to be really strong, because those who did sell on the news or who bought on the news are going to be stuck on the wrong side very quickly. So this is something that to keep in mind. And it can also, other than being a setup, it can also help you exit too. If you were in a trade and it's going your way, and then all of a sudden, it's going higher and higher, and then great news comes out, but it can't seem to go any higher. That might tell you that it had hit some extreme, and maybe it's a good time to get out of your position there before it reverses back down. So this is an advanced setup because news is a bit of an unpredictable thing and there's more volatility. But if you do it selectively and you combine it with the right context, it can provide some good trade. So keep that in mind, start watching it in your own trading, start tracking this type of thing and see if you could get some edge based on this. And then finally, setup number 3 is false breakouts and failed patterns. Now we had alluded to this several times before, but the basic thing here is that oftentimes, more often than not, breakouts and patterns end up failing. And since everyone is watching the breakout and everyone is trying to pile in on the breakout or on some kind of pattern from the normal technical analysis books, these are often great fade trades. The key thing is, and why this is an advanced setup, is doing it before you get the confirmation of the failure. That's the key. Or before the confirmation that it's a false breakout. This one takes experience. But we'll get into a bit of what to look for. And in reality, these 3 setups, when you're discussing anything advanced that needs a certain amount of experience and screen time, the best you can do is really just make someone aware of it. Maybe you weren't trading, supply demand walls before. Maybe you were just completely ignoring the news, or maybe you would only consider something a false breakout failed pattern after it's confirmed that failure. And just becoming aware of it, you start watching it more in your own trading and you start finding an edge to trade. It's difficult to teach per se these setups because there aren't as many structured guidelines to go by, and these things have to be combined with everything else. But that's why they're advanced. The idea here is just to bring them to your attention, and if you haven't been using them, start watching your charts, start looking for them, and train yourself to use them. Of course, if you're using these, you should already be a consistently profitable trader, and picking up new techniques can often be done pretty quickly, and they can give you an added source of edge. So having said that, let's jump into the chart and take a look at them. Alright, so let's start with the first setup, which is the demand supply walls. Now this particular charting platform that I'm using here is called Market Delta, and what you're looking at is something called a footprint chart if you're not already aware of it. I'll provide you with the link to Market Delta in the key takeaways PDF if you would like to check it out. Now, Market Delta itself, it's a very powerful platform. It's a very powerful charting interface, and it can do a lot of things, and people have invented a lot of different ways to trade using it. We like to keep it simple in the way we use it. What we do is that first of all, we use something called a reversal bar, not a time-based bar. Okay, so if you'll notice up here at the top, here it was 10:30. The next bar was 10:38. The very next bar was only 10:39. So from here to here there was 8 minutes, but from the next bar it was 1 minute, then another minute, then 2 minutes, then 5. So it's not time-based. What's basically this is happening is the bar reverses when price moves 5 ticks the other way. That's why it's called a 5 reversal bar. So we have this bar, it's going up, and it'll keep going up. We'll stay in one bar as long as we don't get a 5-point reaction down. Once we do, like here, we build a new bar. Right here, we got 5 points up and we build a new bar, and so on. So it just shows the reversals in the market. And the thing that this allows you to do is really show when there is a hidden supply or demand wall. And the reason for that is that you see we're seeing numbers within these. So what this is showing is that 0 by 693 means that 693 contracts were bought at 68.75, and none were sold there because it never went bid. The buyers are still buying, and we didn't go to the higher price for them to sell at this price. So 693. Here is 27.99 by 4,273. So what it's doing is it's showing you the accumulated actual trades that took place at the bid and at the offer at each price. And it's showing it within each 5-tick reversal bar. Okay? Now you can change this from a 5-tick reversal bar to a 4-1 to a 10-1. You can do whatever you want. Depends on your market, and that's why it's a little more advanced. You're gonna have to experiment with this and see what works best in your market. But what you're basically looking for is this. You're basically looking for the times when you get some really big volume accumulating at a certain price. Okay, and in the S&P, usually just based on experience, anything that is more than usual is usually around 4,000 plus contracts, 4,000, 5,000. Sometimes you'll see much higher, but that's usually above average. So when you're seeing 4,000 contracts at the offer right here, okay, that means there's sellers sitting there in the book, and you've had 4,000 buyers buy this thing, and these guys are absorbing all of it. Now, yes, it did trade a tick higher, so this thing isn't exact, but it shows that a lot of buying pressure was absorbed in this area. Here we got a lot more. It was to both sides. It was this whole general area. So it's basically showing you volume at price, showing you horizontal volume, and this thing keeps moving, by the way, because we're in live markets that aren't showing on the right. But anyway, it shows you horizontal volume on a mini scale. Instead of just using a general profile, you're seeing it at each price within each few minutes. Okay, here is obviously an equilibrium point where there was 7,800, which is a big number, and 6,000. Here there was 8,000 to the bid. So both buyers and sellers were absorbing each other in this area and just spending a lot of time right here. Now, here's the way this works. Really, it's most useful by far during trend days, okay? And it'll help you get on board trend days more effectively. What'll often happen is that as we're getting a reaction, so this particular day was a downtrend day, and as we're getting a reaction higher, unless we just kind of spurt higher on little volume and we hit a tick extreme and we quickly reject it, in which case you can get short using another type of setup, an exhaustion setup. But sometimes we'll just go slowly and we'll just sit there sideways. And if you're looking on a chart, you can't tell anything. It just kind of looks like it's just going sideways a bit. But often when you look at these and you see all this major volume accumulation at a certain price, even if it goes above it by a few ticks and then builds another one, the general area is usually a stopping point, and then price will react back down and the trend will continue, or at least we'll get directional movement the other way in the direction of the trend. So these can often end up being good entry points with the trend. Either when you see, ideally, a lot of buying, even though you're in a downtrend, you see a lot of buying but it's being absorbed on the offer, that's usually a good short and the buyers can't really keep taking it up. Or you see equilibrium between sellers and buyers to both sides, really can't move it higher in the case of a downtrend. Even though it's equilibrium, since the context is down and the bears are overall in control, usually equilibrium is going to be solved to the downside, to the direction of the trend. So that's usually a good entry point. Let me show you where this thing specifically was when you were looking at a candle chart. Alright, here we are. And it was right here. This is where we were. As you see, we had came down, strong down movement in the morning, popped up, and now we're popping up again. And absent any extremes or anything right here, there might not have been a reason to sell. But when you see that major equilibrium and you see the wall of supply on the next push up, that can usually provide a great entry right there. And it doesn't mean that the trend is just going to tank straight down. Of course, this is short term, but it would give you good trade location in the short term. You can put your stop a couple points higher just in terms of a volatility stop, because if we just kept breaking through that equilibrium point, then it's invalidated. And in this case, we quickly got like a 5 or 6 point drop. So often that's what can happen in the right context. Here it's in trend days. All right. Now another way to use them is to confirm certain support or resistance areas. If you have a zone and maybe it's not a massively important zone that's gonna give you an automatic buy or sell, but you see some major, for instance, the price is going down, and it wouldn't be in a trend day, right? Let's assume this was just a normal day and price is going down, they hit a support area. So the sellers are hitting it, they keep pounding it, they keep selling, and that specific price on market delta keeps getting more red and more red, because on market delta the shades of color happen to be linked to the difference between the amount of contracts at the bid versus at the ask. So if we're getting a lot at the bid versus the ask and there's a lot of selling, that might seem bearish, but it's all being absorbed and price still can't break down. What end up happening is that once finally the sellers are exhausted temporarily, the selling pressure is finished, we'll usually we get responsive buying, and then any short-term sellers that were selling there get stuck, and then like here it would happen something like this. They would be covering really quickly, the really short-term ones, the scalpers, and we'd be flying back up. And so that's often good to confirm support resistance zones that aren't automatic buys or sells. If you get major equilibrium or major demand wall or major supply wall, that could be a good reason to just enter right there, absent any anything against it in terms of bigger context. Okay, so this is a cool setup. You have to take your time in learning the footprint chart, seeing what kind of reversal size in terms of bars to use in your market. Usually what works best is just switch between the bars to find the tick reversal size that shows you at certain points good accumulation at price. Because for instance, if you use the 2-tick reversal, it's going to keep reversing because the market will easily move 2 ticks in one direction and the other, and you'll never see the accumulation at price, right? So you want to balance it somewhere in the middle, and it just gives you a shorter term horizontal volume view of the market than you would get by looking just at a bigger profile that keeps accumulating the same price over and over. But when you have experimented, you're finding the right tick reversal, And by the way, the tick reversal size should actually change when we get major changes in volatility. If we've been using a 4 tick reversal size and that's been good, and then all of a sudden we get major volatility expansion and the ranges of the days are 2 or 3 times larger than usual, then you might want to go to a 6 or an 8 tick reversal chart, because 4 ticks might be happening randomly left and right, and you just keep changing and you never see any volume accumulation. So it's something that's going to need some sort of dynamic adapting. You'll have to play around with it, and then always use it in context. It's good to use it during trend days. It'll often give you great entry points against the counter trend reaction back the other way, and it'll often be good even on range bound days at the support or resistance zones, showing that no matter how much the sellers or the buyers are pushing, they can't break through that zone right at that time. All right, and so let's move on to the false breakout or the failed patterns. And like we said, setup number 2, the news, that's just something you're going to have to look into on an ongoing basis to develop your feel for when there's good trade setups, when you don't get a good reaction to news that should technically cause one. All right, so let's move to the failed breakouts and patterns. All right, let's talk about the failed patterns, failed breakouts. Okay, now the reason why this is an advanced setup is because take a look at this, right? We have this, most of this day was sideways, open up the next day also going sideways, and now we're breaking out. Okay, now for all intents and purposes this looks quite bullish, but what if, based on your larger contextual market analysis, you felt that the upside should be capped and that any real up move here would not be sustainable? Now, of course, you wouldn't be able to make such a statement or have such a view unless you were relatively advanced in your trading, you had lots of screen time, and you had your own reasons why you thought a breakout above here would not hold. Well, in that case, oftentimes it makes sense to anticipate a failure before you get confirmation of it. You see, everyone knows about failed breakouts and failed patterns. The problem is most people are getting in when price fails and comes all the way back here, and now they're getting in, but that's not really good trade location and they end up getting chopped up. That's how most traders try to play it. But if you're advanced enough to be able to read the market, to be able to have a much larger contextual view, and to form your own opinions of the most likely scenarios to happen and the odds of those things happening, and if you felt, based on whatever larger context, which we're not going to get deep into now because that'll take quite a while to explain all that, but if you had felt for whatever bigger picture context that the upside was limited and that the bulls did not have enough strength in the bigger picture to sustain this kind of move, and included on that this type of day was not conducive to sustained directional movement, that you expected it to be more of a range bound day, and that any directional conviction one way would be limited and reversed, right? You knew that there was very little chance that this would be a trend day, and some other context told you that it would more likely be a balanced day. Well, then that could give you more than good reason to expect that any potential upside breakout could fail. And at this point, if you're seeing this, which looks so great and so bullish, right above the top of this previous range, knowing that the odds are low that we could sustain a breakout, you might want to short it right there, right? If it looks so bullish and we're getting these bar expansions, and yet everything else in the bigger picture and the potential of the day is saying, hey, we're not going to be able to sustain this kind of thing. And not only that, we've made it all the way straight up, pretty much with no retracement, 9 points almost straight up. That could be the perfect place for short-term exhaustion. And at the very least, you might have good short-term trade location to get short with a volatility stop a couple points higher, expecting a retracement back down, a complete failure, and knowing that if you did get the failure, right, you could get a big breakdown. Now, the good thing about entering these types of things is that if you're entering at the right time where it's already quite stretched, looking so bullish, short-term exhausted, if you entered with a couple point stop, often, even if this wasn't going to be a false breakout, you can quickly get that 2 point pullback to test the top of the zone, because it didn't come up here and balance for an hour and then break out. It was coming straight from here all the way up. So it's hard to sustain that kind of thing, especially in an environment that's not conducive to it. And so that might be a good short right there, knowing that you can easily scale out of half your position right here, and then see if you're going to get the bigger breakdown, right? Now, let's see what happened here. All right, we see that it hit here, went slightly higher, balance, and then bam, is the breakdown. This is usually the point where most traders are getting in. They see the big breakdown. And sometimes if it's going to really break down to the other side, this might not be a terrible point to get in, but obviously a huge difference between here and here. And so of course you didn't know that this was going to happen right there. This thing could have kept shooting up and you took a loss. Okay, you got to think about it long term. Sometimes that'll happen, but if you were right on your read of the bigger context and of the lack of likelihood for sustained directional movement, then getting this pullback at least to here to scale out of half and be a zero risk is very high odds, right? And then let it play out and see what happens. Let's keep going to the right. And so there we go. We ended up, going down and really making new lows on the day. We ended up, if you had shorted here at the scariest point when it looked like everything was going to work based on all your contextual information, and you scaled out of half here, you could have at least had a nice trade to the retest of the lows. And of course, once you know that if something breaks down and then goes straight down through the high volume node to the lows, usually it'll break through to the other side, so you might have even held to a little breakdown below that. Either way, it was a nice 4-to-1 or so, and after the scale out you end up with a 2.5-to-1 reward to risk. Not too bad at all for this type of trade, and that's what'll often happen with these kind of trades. Basically, my point that I'm trying to make here is that obviously this is an advanced setup because you have to have enough contextual awareness to know when it's likely that the breakout that's coming is actually against the bigger context and it's not likely to be sustained. Okay, so this is a good example of that. At other times, some things will help you. You'll not only have that bigger general awareness, but you'll also see a major tick extreme showing exhaustion, or you'll see a divergence. It'll go up, then it'll try to go a little higher, it'll diversion, go down, or like we just said, you combine it with setup number one and you'll see some major, for instance, supply wall right here, or equilibrium, showing that no matter how much buyers are buying, it's all getting absorbed and they're going to get stuck in those longs. So that's a good one too. And once you combine those, that'll give you more confidence to take a trade like this when it looks the scariest, when there's no particular zone. Those are usually good ones. And then, these will often work really well during trend days. So if you have like a midday balance and then it looks like it's breaking out of it to the upside and you're in a downtrend, you can just take the trade right there, assuming you're going to get a failed breakout. Why? Because you know that the context is bears are in control, it's a strong downtrend. Same with an uptrend. If you're in an uptrend, strong uptrend, you have a midday balance area and then you get a breakdown out of it, that may look scary, and unless the whole trend day character is looking suspect, then you gotta assume that, hey, this is gonna be a fake breakdown. It's gonna catch the sellers in a trap, it's gonna catch them off guard, and it's just gonna reverse right back up. So don't wait for the confirmation of that. Take it right there. It's like any other trade. You think in probabilities, you take it. Okay? And again, you can use other things to help you, like the extremes or the walls or divergences or whatever else you may use as a confluence to help you do that before it's confirmed. And the same goes with patterns. Sometimes you'll get, you'll be in a downtrend and you'll get a nice looking head and shoulders pattern and it'll shoot up, confirming as if it's going up. And a lot of traders will look at that and be like, oh, this is textbook, I gotta buy it, not looking at the bigger context, which is, hey, this is a strong downtrend and we're most likely going to close near the lows. We're likely going to make the lows in the last hour. So that's probably not sustainable. And when it hits that extreme, you short it and it goes back down great majority of the times. And all those that went long on that head and shoulders, inverse head and shoulders pattern are now stuck, and your profits get accelerated. Same with double bottoms, double tops, and things like that. Those are usually really good when played in context. And the key point here with this setup is you never wait for them to actually fail. You do it at the point, the crescendo, when there's a momentum peak and it feels like they're actually succeeding. And that's usually when they stall out and fail. So I hope you'll make use of these setups. Like I said, I can only make you aware of them if you hadn't already been trading them, tell you about how we trade them, and then of course it's up to you to take a look at the market and study them more deeply and start becoming more aware of them, and maybe have a psychological shift in how you look at them and start capitalizing from these type of trades. But if you do, they can often provide some great profit potential to add to your basic strategies once you're an advanced trader and you really know what you're doing with all the basic stuff. Alright, so good luck with these, and with that, this particular section ends and we move to the last one, the all-important section of psychology and the mind.